Solus Alternative Asset Management's chief strategist. He's here with me at Post 9. Welcome back. It's good to see you.
Thank you, sir.
What about that? Are we on that march to these new highs?
I went back and I took a look, and it turns out that the last time the Dow went up 14 days in a row, the market went up for the next 120 years. And so I think we're really setting up for a breakout to the upside.
1897 is when you're calling that out. But, you know, this fade that we're seeing, because rates, you know, the 10-year moving above 4%. Just what do you think about that relationship? What do we have to keep our eye on when it comes to treasuries, and then what the relationship's going to be with stocks?
I think people have a bit of a misconception about what rates mean in many circumstances. Pre-2000, rates on balance were bad for risk assets, equities in particular, because rates were more linked to the inflation landscape. What you've seen post-2000, and I think increasingly what you're seeing right now, is that rates are going up, to borrow a phrase from Bachelorette, for the right reasons. You're seeing rates go up because the supposed economic weakness that people like myself were forecasting a year ago has not materialized. And as rates have gone up, the 2 years up about 100 basis points in the last month and a half or whatever, the stock market's gone straight up alongside of it, including technology, both large cap and small and mid.
Are you in soft landing camp now? Is that your base case after thinking that, you know, historically when the Fed does what it's doing and has done already, you're going to get a recession, yield curve still inverted, LEI, leading economic indicators, all pointing in that direction? Yeah,
listen, I was one of the charter members of this group that said when the Fed does this sort of thing, then negative economic outcomes are almost always the outcome you should bet on. I think what's become clear is that this environment is a little different from a top-down standpoint. The amount of money that we distributed people, the size of the fiscal deficit as it currently stands is still 8% of GDP. The strength in the labor market and obviously the relative high level of inflation has really complicated this environment. And so I think a lot of the observations that camp makes, in which I once was a charter member, I think still holds. But you also have to be, to borrow a phrase, tactical, so to speak. You can't sit here and be wed to your views when things are not going your way. And for the last 6 months or so, it's been clear that the economy and the corporate backdrop is certainly, on balance, suggestive of higher equity prices.
Many of the bears have been very much wed to their views. You've seen some capitulation from some. Not that Mike Wilson, for example, is all of a sudden bullish at Morgan Stanley, but nonetheless says we were wrong in thinking that, you know, earnings were going to roll over. Didn't see the AI thing coming, and not that anybody did, to the degree at which we've seen it. But are you saying that now you are in the soft landing camp? No recession?
No, I don't know that I'd go that far. I think I
thought you were about to go that far.
My market religious journey over the last, call it 6 to 8 months, was gradual. And so far be it from me to criticize someone for capitulating later than me or whatever it was. The technicals worked in your favor earlier in the year, and then the economic and the fundamentals came to support you thereafter. Am I in the soft landing camp? I mean, listen, the odds are higher today that there will be a soft landing and they can pull this off than they were 3 or 6 months ago, let's say, or even 9 months ago. But getting back to the point, you brought up the yield curve and the leading economic indicators. Those sort of forward-looking indicators have worked for decades. And while I think the current environment is more complicated and by extension different than what we've seen historically, you still have to sort of have some hesitancy on the idea that those indicators are eventually going to work.